Welcome to Investor Hub X. In this video, we're going to break down bull markets and bear markets, what they are, how to identify them, and why they matter. You'll learn how to recognize a bull market, how to spot the end of a bull market, how to recognize a bear market, and how to identify when a bear market may be coming to an end. This is not about prediction, it's about understanding market structure and momentum. Once you understand these phases, your trading decisions become clearer and more disciplined. Let's get started. So, how do we identify a bull market? The first way to identify a bull market is by looking for higher highs and higher lows. This is a Bitcoin chart on the weekly time frame. Now let's focus on the price structure. Notice how each swing high is higher than the previous swing high. And notice how each swing low is also higher than the previous swing low. This tells us that buyers are stepping in earlier on every pullback, and they are willing to pay higher prices over time. When price consistently forms higher highs and higher lows, we call this a bullish market structure. In other words, the market is in an uptrend. So, how do traders operate in this environment? In a bull market, traders do not chase price at the top. Instead, they wait for pullbacks. Pullbacks often occur at support levels or areas of value within the uptrend. This is where traders look for long opportunities, aligning their trades with the direction of the market. In an uptrend, the market does the heavy lifting. The trader's job is simply to align, not to fight it. The second way to identify a bull market is by looking for breakout of patterns. Again, we'll use the Bitcoin chart to illustrate this concept. Price moves up and then enters a period of consolidation. Consolidation occurs when the market temporarily pauses, with price moving sideways instead of trending. During this phase, price often forms common chart patterns such as rectangles, triangles, flags, or wedges. Consolidation reflects market indecision, as buyers and sellers temporarily reach a balance. When price eventually breaks out of the consolidation pattern, it signals that buyers have regained control. In a bullish environment, a breakout to the upside confirms that the bull market is continuing. The third way to identify a bull market is by looking for massive bullish engulfing candles. When you see multiple massive bullish engulfing candles forming, it tells us that strong buying momentum is present in the market. These candles show that buyers are stepping in aggressively, overwhelming sellers and pushing price higher. This kind of price behavior is a sign of strength, not exhaustion. In a bullish environment, the repeated appearance of bullish engulfing candles often confirms that the bull market is likely to continue. Strong trends reveal themselves through strong candles. The fourth way to identify a bull market is by identifying clear trend lines, which show the direction of the underlying trend. This is the fourth way to identify a bull market. As price continues to form higher swing lows, these swing lows allow us to draw an upward trend line. When price consistently respects this trend line, it confirms that the market is in a clear uptrend. In a bullish environment, the trend line often acts as dynamic support. This means that long trade opportunities frequently present themselves when price pulls back toward the trend line. It's important to understand that price does not always touch the exact swing low. In strong bull markets, price often pulls back above the trend line before continuing higher. This happens because buying pressure is so strong that buyers step in earlier without waiting for deeper pullbacks. In these cases, the trend line still represents the overall direction of the trend, even if price doesn't react at the exact line. This is why trend lines should be treated as zones, not precise levels. In strong trends, price respects momentum, not precision. The fifth way to identify a bull market is when price is clearly above the moving average. In a bull market, price tends to remain above the moving average, with pullbacks often finding support around it. This tells us that buyers are still in control and that bullish momentum remains intact. In this environment, the moving average often acts as dynamic support. Traders commonly look for long trade opportunities when price pulls back toward the moving average rather than chasing price at the top. In this example, we're using the 50-day moving average. The 50-day moving average is commonly used to gauge the medium-term trend of the market. In a healthy bull market, price generally stays above the 50-day moving average, with pullbacks often finding support around it. However, it's important to understand that price does not always respect the moving average perfectly. In some cases, price may briefly dip below the 50-day moving average and then quickly reclaim it. When this happens within an established uptrend, the dip does not automatically signal weakness. In fact, when price reclaims the 50-day moving average and continues higher, this move can represent a potential buying opportunity, as it shows buyers stepping back in and defending the trend. The key is confirmation. Price should move back above the moving average and hold rather than remain below it. A moving average is a guide, not a hard rule. Next, we are going to discuss how to identify the end of a bull market. The first warning sign of a bull market losing strength is the formation of lower highs and lower lows. In a healthy bull market, price consistently makes higher highs and higher lows. But when momentum begins to fade, that structure starts to change. Notice how price fails to break above the previous high. Instead, it forms a lower high. Then, on the next pullback, price breaks below the previous low, forming a lower low. This tells us that buyers are no longer in control. Rallies are becoming weaker, and sellers are stepping in earlier. When the market starts printing lower highs and lower lows, it signals that the bullish structure is breaking down. This does not mean the market must immediately collapse, but it does mean the bull market is likely coming to an end. At this stage, traders should become more cautious, reducing aggressive long positions and paying closer attention to risk management. Once market structure begins to weaken, the next thing we often see is a breakdown of price patterns. For this example, we'll use a Bitcoin chart on the weekly time frame. After the initial decline, price enters a period of consolidation, forming what's known as a bear flag. A bear flag looks like a pause in the market, but in reality, it represents temporary relief before selling continues. When price breaks down from the bear flag, it confirms that sellers remain in control. In the context of a weakening bull market, a pattern breakdown like this signals that downside momentum is taking over. One of the clearest signals of this shift is the appearance of massive bearish engulfing candles. A bearish engulfing candle forms when strong selling pressure completely overwhelms the previous buying attempt. These candles show that sellers are stepping in aggressively, often erasing prior gains in a single move. In the context of a bull market topping out, this is often a sign that control is shifting from buyers to sellers. The fourth way to identify the transition from a bull market to a bear market is the appearance of a massive gap down. A gap down occurs when price opens significantly below the previous trading range, leaving little or no overlap with prior price action. This usually reflects sudden selling pressure, often driven by fear, forced liquidations, or a sharp shift in market sentiment. When a massive gap down appears after bullish structure has already weakened, it confirms that buyers have lost control and that the market is transitioning from a bullish environment to a bearish one. The next way to confirm the transition from a bull market to a bear market is a break below the trend line. In a bull market, an upward trend line connects a series of higher swing lows and acts as dynamic support. As long as price respects this trend line, the bullish trend remains intact. However, when price breaks below the trend line, it signals that buyers are no longer able to defend the uptrend. This break shows a loss of momentum, and it often marks the point where control begins to shift from buyers to sellers. The next way to confirm the transition from a bull market to a bear market is a break below the 50-day moving average. In a bull market, the 50-day moving average often acts as dynamic support, with price staying above it during healthy trends. When price breaks below the 50-day moving average, it signals that bullish momentum is weakening. If price remains below the moving average and begins to reject it as resistance, this confirms that buyers have lost control. Moving on, let's talk about how to identify the bear market. Now that we've covered how a bull market ends, let's look at how to identify a bear market. The first and most important way to identify a bear market is the formation of lower highs and lower lows. In a bear market, price fails to push higher. Each rally tops out below the previous high. These lower highs tell us that buying pressure is weak and that buyers are no longer willing to pay higher prices. At the same time, each sell-off pushes price below the previous low, forming lower lows. When price consistently prints lower highs and lower lows, it confirms that the market is in a downtrend and that bearish momentum is dominant. This is the defining structure of a bear market. The next thing we often see in a bear market is a breakdown of price patterns. Instead of breaking upward, consolidation patterns begin to fail to the downside. These breakdowns confirm that sellers remain in control and that bearish momentum is continuing. Another clear way to confirm a bear market is the appearance of massive bearish engulfing candles. A bearish engulfing candle forms when strong selling pressure completely overwhelms the previous buying attempt. These candles show that sellers are firmly in control, often erasing gains in a single move. When bearish engulfing candles appear repeatedly, they confirm that bearish momentum is dominating the market. Another clear way to identify a bear market is how easily you can draw a downtrend trend line across swing highs. In a bear market, price repeatedly rallies into this trend line and fails. This downward sloping line acts as dynamic resistance, where sellers consistently step in. Because of this, short trade opportunities naturally present themselves near the trend line. These are not random shorts. They appear at areas where the market has already shown rejection. Until the trend line is decisively broken and reclaimed, rallies should be viewed as selling opportunities, not signs of a new bull market. Another clear sign of a bear market is when price trades consistently below the 50-day moving average. In healthy bull markets, price tends to stay above the 50-day average and use it as support. In bear markets, that relationship flips. The 50-day moving average turns into dynamic resistance, where price rallies into it and gets rejected. Each failure at the 50-day average tells us that momentum remains weak and sellers are still in control. As long as price stays below this level, rallies should be treated with caution. Until price can reclaim and hold above the 50-day moving average, the broader market bias remains bearish. Next, we'll talk about the conditions required for a market to transition from a bear market into a bull market. The first sign that a bear market may be ending is when the market starts to make a higher high. In a bear market, every rally fails below the previous high. A higher high tells us something has changed. It shows that buyers are now strong enough to push price above a previous swing high. This is an early structural shift, not a guarantee of a bull market yet. But without a higher high, a bear market cannot transition into a bull market. After the market makes a higher high, the next key sign to watch for is a higher low. In a bear market, pullbacks continue to break to new lows. A higher low tells us that sellers are losing control and buyers are stepping in earlier than before. This shows that demand is now strong enough to defend price at a higher level. When a higher high is followed by a higher low, the market is no longer in a clear downtrend. This combination marks a meaningful shift in market structure and increases the probability of a transition into a bull market. The next sign that a bear market may be ending is a break above a consolidation pattern. When price breaks and holds above this consolidation, it signals that selling pressure is weakening. This tells us that sellers are losing control. While not every breakout leads to a bull market, a sustained breakout is an important step in transitioning out of a bear market. We often start to see bullish engulfing candles appear when transition from a bear market into a bull market. These candles signal a sudden shift in control, where buyers overwhelm sellers in a single move. While no single candle marks a market bottom, bullish engulfing patterns frequently appear near the early stages of a trend transition. They provide additional confirmation that downside momentum is fading and demand is starting to take over. Another sign that a bear market may be ending is a massive gap up in price. A gap up shows that buyers are willing to pay significantly higher prices than before. This reflects a sudden shift in sentiment and demand. While not every gap leads to a bull market, a large gap that holds and does not get filled often signals an important transition from bear to bull. Another key sign that a bear market may be ending is a break above the downtrend trend line. In a bear market, this trend line acts as dynamic resistance, repeatedly rejecting price. When price breaks and holds above this trend line, it signals that sellers are no longer in control. This marks a structural change in the market and is an important step in the transition from bear to bull. The final sign that a bear market may be ending is a break above the 50-day moving average. In a bear market, the 50-day moving average acts as dynamic resistance, repeatedly rejecting price. When price breaks and holds above the 50-day moving average, it confirms that momentum is shifting. This does not guarantee a bull market, but it signals that the broader market bias is starting to turn bullish. To summarize, we've learned how to recognize a bull market and how to spot the early signs that a bull market may be ending. We've also covered how to identify a bear market using structure, trend lines, and moving averages. Finally, we explored the key conditions that signal when a bear market may be transitioning into a bull market. The goal of this section is not to predict the market, but to understand what the market is actually doing. When you can recognize the environment you're in, you stop guessing and start making better, more informed decisions. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.